Welcome to the world of Test Portfolio XSX. This video was created with the help of artificial intelligence. It provides a weekly summary of key economic events. The featured portfolio is simulated, fictional, and reflects my personal perspective on recent market developments. My main goal is to explore whether the S&P 500 can be outperformed. To do this, I compare the performance of three different portfolios: my own fictional portfolio, an S&P 500 portfolio built using a lump sum investment strategy, and an S&P 500 portfolio built using the dollar-cost averaging method. This video reveals which strategy performs best and why. Disclaimer: this video does not constitute financial advice and does not recommend the purchase or sale of any financial instruments. I do not take responsibility for any potential inaccuracies or errors that may occur. Ready to get started? Let's go. This was the week when everyone breathed a sigh of relief, and then held their breath again. The rally kicked off on Monday. The S&P 500 finally smashed through the dream barrier of 6,000 points, and the NASDAQ was closing in on its record high. Investors cheered the new inflation numbers: 2.4% year-over-year CPI. They couldn't have dreamed of anything better. The market seemed to believe at last, the rate hiking cycle is over. Tech stocks took off, the AI fever flared up again. Meanwhile, upbeat rumors floated around the China-US trade talks. Everyone was buying. But, on Friday, geopolitics blew up. Israel launched strikes on Iranian military targets. Iran hit back drones, missiles, total fear along the Middle East oil corridors. Oil jumped plus 8%. The Dow Jones dropped 769 points. The VIX spiked plus 17%. The market slipped back into the anxiety zone. Sector winners and losers. Geopolitical tensions drew a sharp line between winners and losers. Energy giants like Exxon and Chevron profited almost instantly from the oil price surge, while defense heavyweights such as Lockheed Martin and Northrop Grumman rallied on growing arms race expectations. These sectors became investors' escape routes when global uncertainty spiked. Conversely, airlines came under heavy pressure. Middle East airspace closures and soaring jet fuel costs drastically raised operating risks. Shares in Delta, United, and other international carriers weakened noticeably. Small-cap stocks and cyclical sectors also took a hit, as money rotated towards safer assets. What to watch next week? The Fed's rate decision held no surprises, but July and September could be a different story. Traders are now laser-focused on China-US negotiations, Middle East developments, and the next round of inflation/labor market data. Question for the viewers: how much do you think the market has already priced in geopolitical risks? Drop your thoughts in the comments, and if you liked the video, smash that subscribe button. Closing note: the week started off looking bright. By the end, it turned out 2025 still has plenty of surprises in store. Weekly Earnings Recap, June 9th, 2025, USA. The summer earnings season is only just getting started, but the market has already reacted sharply to a handful of key reports, especially in tech. This week, investors cared not only about the raw numbers, but also about forward-looking guidance, AI-driven narratives, and certain sectors' geopolitical exposure. Adobe beat expectations with revenue of USD 5.87 billion, plus 11% YY, and EPS of USD 5.06, and it even raised its Q3 profit outlook. Still, the share price fell roughly 5–6% as investors fretted over intensifying generative AI competition: OpenAI, Canva, Google. In other words, the market punished the future, not the past. Oracle shot up more than 13% after revealing explosive growth in its cloud infrastructure unit, OCI. Management said AI demand has pushed its contract backlog to USD 130 billion, making Oracle the clear winner of the week. Boeing slid about 4.8%, not for financial reasons but because a 787-8 malfunction on an Indian flight spooked the market. The reaction underlined how fragile confidence remains, especially given lingering regulatory risks. GameStop, weak preliminary results plus a USD 1.75 billion capital raise sank the stock 20%. Oklo, the clean energy firm, jumped 30% on news of a government tender win. CureVac shares soared 38% after announcing a deal with BioNTech. Sector performance, S&P 500 Q2 forecasts, FactSet. Tech, strongest expected profit growth plus 15, 9%. Communication services, for example, Warner Brothers, plus 29, 4% profit growth. Energy, biggest loser, expected earnings decline minus 26.1% on lower oil prices. AI-linked stories still drive sentiment, but the market no longer claps blindly. Strong results won't lift a stock if competition is heating up or guidance looks shaky. Firms that pair solid fundamentals with a convincing forward vision, like Oracle, get rewarded instantly. Meanwhile, renewed geopolitical noise has thrown defense and aviation back into the spotlight. On Friday, the sky suddenly darkened over the markets. The mood had been optimistic all week. Then came the cold shower, geopolitical tensions, troop movements, and unsettling news from the Middle East. Some investors panicked. The S&P 500, NASDAQ, and Dow all rolled over as if struck by lightning. But I'm not changing my strategy. Why? Because I don't build a strategy to change course in every storm. I build it so I know what I'm doing when others lose their compass. The current situation is geopolitical in nature, not an economic-based crisis. Corporate earnings remain strong, momentum in the tech sector is intact, and my stock picks were made through rigorous analysis, not day-to-day sentiment. My portfolio is driven not by fear but by strategy. That doesn't mean I'm blind to risks. It means I know the market has always been cyclical. Anyone who bolts at every dip also misses the real rallies. Now comes the real question. How do you react when everyone else is selling? So let's see how the three strategies have evolved. Strategy 1. Lump sum, one-time investment. The first investor bought an S&P 500 ETF on January 2, 2025, investing the entire $15,000 at once. They've held the position ever since, no additions, no withdrawals. Current performance year-to-date, 1.62%. The blue line reflects this result based on the most recent Friday closing price. Strategy 2. Dollar cost averaging. Gradual investment. The second investor splits the $15,000 into 12 equal parts, investing $1,250 on the second trading day of each month into the same S&P 500 ETF. This approach helps smooth out volatility and reduces the risk of poor entry timing. Current performance year-to-date, 2.46%. The green line reflects this strategy, slightly outperforming the lump sum method so far. Strategy 3. My fictional portfolio. This portfolio is based on my own stock picks and investment decisions. It launched on March 19, 2025, with the full $15,000 invested in various individual stocks over multiple transactions. I've explained my choices in earlier videos. Current performance, 7.30%. Note, these performance metrics exclude broker fees and taxes. They reflect only market-based price movements. It can be seen that there is currently little difference between the results of the strategies, but my fictional portfolio with chipmakers is very volatile and dropped significantly on Friday. Which sector do you think will be the winner if you were to invest now? Let's recap how we got here. Test portfolio XSX, red line. After a flat start to June, it suddenly moved sharply higher. From about -2% at the end of May, it climbed steeply to above 10% by mid-June. It delivered the highest return of the three portfolios for the month. Lump sum strategy, S&P 500 benchmark, purple line. Also turned positive in June, tracking XSX, but more slowly and less dramatically. It sat near -1% at end May, and rose gradually to roughly 2.78% in June. Dollar cost averaging, green line, followed a similar upward path. From around -1% at the end of May, it moved toward about 3.61% by June. June trend in one sentence. Test portfolio XX outperformed decisively, while the other two posted mild but steady gains. XSX's rise was far steeper and faster. Sharp pullback on the final Friday, test portfolio XSX, red line, experienced the largest drop, falling from its mid-month peak above 10% to 7.30%. Lump sum strategy, S&P 500 benchmark, purple line, slipped modestly to 1.62%. Dollar cost averaging, green line, also corrected slightly to 2.46%. Final day takeaway, XSX surrendered the biggest chunk of gains in the last session, while the other two saw only minor pullbacks. and their prior advances had never been as steep. Thank you for joining us on this economic journey with Test Portfolio XSX. If you enjoyed this weekly recap of the key events and our portfolio's performance, give it a like, subscribe, and join us again next week as we review the latest market moves and the progress of our investments. Disclaimer: this video does not constitute financial advice and does not recommend the purchase or sale of any financial instruments. I do not take responsibility for any potential inaccuracies or errors that may occur.